And you put in that perspective, even marking to market, where gold prices are currently, we're about 2% of those treasuries outstanding. Back in the 70s, I believe we got close to 17% at its peak. And those 70s was really because central banks were accumulating gold at that time, just like today. The other time was in the 1940s, when the U.S. was really getting ready for the war. We saw money supply increase, the debt increase, but we're close to 40% of U.S. gold reserves relative to treasuries outstanding. So I think it's important to put into perspective of how much we've gone away from the anchor of owning a actually monetary metal to put real value into a currency. And if we're going to go back to the 17%, it takes us back to 25,000 dollars an ounce. Or if we go back to the 40%, it's closer to $55,000 an ounce.
Historically, gold reserves have played a crucial role in backing U.S. debt, but their relative value has significantly declined. In the 1970s, gold reserves covered up to 17% of outstanding treasuries, while in the 1940s, during wartime, they reached nearly 40%. Today, they cover only about 2%, reflecting a shift away from gold as a monetary anchor. If the U.S. were to return to historical levels, gold prices could surge to $24,000 to $25,000 per ounce at 17% coverage, or even $55,000 per ounce at 40%, highlighting the vast disconnect between gold reserves and national debt today. Tavi Costa, a prominent global macro investor, explains that Western societies are now joining the gold bull market, which was previously driven by Eastern nations. Since the global financial crisis, international central banks have aggressively accumulated gold, reaching 50-year highs, while U.S. gold reserves remain at their lowest levels in 90 years. This growing divergence may push the U.S. to reconsider its stance and accumulate gold again, especially as sovereign wealth funds and asset monetization discussions gain traction. With gold prices rising due to central bank demand, the next surge may come from a weakening dollar, similar to trends seen in the early 2000s. Tavi Costa highlights that the U.S. is in a precarious position, as rising debt has led to interest payments reaching 5% of GDP, making rate cuts a priority to ease the burden. Lowering interest rates, however, weakens the dollar, as seen historically with the correlation between the 10-year yield and the dollar index. Despite the dollar being historically overvalued, investors should focus on future trends rather than past strength. A potential coordinated effort by central banks to devalue the dollar could further drive gold prices higher, signaling a significant shift in global financial dynamics. History provides two key precedents for coordinated currency devaluations: the 1985 Plaza Accord, where central banks collectively weakened the dollar to boost global growth, and the early 1930s, when multiple countries abandoned the gold standard, strengthening the dollar until the U.S. devalued it in 1933 to end the Great Depression. While today's situation may differ, the dollar is at its peak, raising questions about whether a natural market shift or a coordinated effort will drive its decline. For investors, this environment signals potential opportunities in emerging markets and undervalued natural resources. Before diving into the video, subscribe and hit the bell icon to stay updated with our latest uploads. We'd love to hear your thoughts, so don't forget to share your feedback in the comments.
Yes, and I would say that finally we're seeing Western societies participating in this more broadly driven gold bull market that we're now, before it used to be more Eastern societies. Look, since the global financial crisis, international central banks have been buying gold, there's no tomorrow. We're back to 50-year highs in that front, while the U.S. is still holding its lowest levels of gold reserves in 90 years. And so clearly that divergence is going to push either the U.S. to start, acting on it and actually changing their policy, which I think is long overdue, to accumulate gold, which would be insane. Most people would disagree with that in terms of the potential of that happening. And I do think it's a real possibility. Listen to Scott Besson, what he's been saying about monetizing assets and sovereign wealth funds, of which he didn't say that he's going to be buying gold into this. But those things are starting to form, in my view, a framework to potentially start seeing the U.S. finally participating in that market again. So I think we're in that turning point in history where some of these figures about U.S. reserves of gold relative to treasuries and all are starting to matter. And to me, this all comes back to the dollar. We've had gold prices moving higher because of international central banks. I think the next leg up is because, kind of like the early 2000s, where the dollar devalued versus other fiat currencies. I think we're in moment right now, of which why I pay so much close attention to the dollar index at this point. The U.S. is in an interesting position. You can grow debt as much as you want. In terms of studying back the empires and other reserve currency status that we had in history, you can grow your debt to a substantial amount. What you can't do is be spending close to 5% of GDP in interest payments and just to service the debt. And so ultimately, that creates a prioritization of particularly lowering rates. And so when you start seeing rates being reduced because of the risk of a sovereign issue, that creates pressure on the dollar. And so therefore why, if you look at the 10-year yield and the dollar index, they're the same thing. And so clearly there is a real push from the administration to lower all rates, not just 10-year, but the Fed funds rates as well. So we can reduce the interest payment to GDP from a 5% level to maybe more of an international level. International levels are running half of that. So from an interest relative standpoint, that change of interest rates from the US is likely to have an impact on the dollar in a big way. And look, throughout history, the dollar is now at probably at its most overvalued levels in history versus other currencies. It's funny, nobody, the idea of thinking the US is the cleanest of all dirty shirts was the thought you should have 5 years ago, not now. Like we're at the peak, not at the bottom. And so telling that story to me, it's sort of, reporting things that have already happened rather than the future, which is the role of an investor. So I'm much more focused on either an organic or a coordinated act by central banks to reduce the value of the dollar that then ultimately pushes gold even higher. There's so many different ways. I mean, if we go back in history, there's two precedents of that. One was 1985, which was the Plaza Accord. The Plaza Accord, we saw a coordinated act across central banks to reduce the value of the dollar to stimulate growth globally. Now, in the 1930s, we saw something completely different. It was the Great Depression, and 1931, we had a bunch of central banks, or I should say countries, the UK, Japan, Canada, Germany, Austria, they all devalued their currencies versus gold. They actually broke their gold standard domestically before the US. And so that drove the dollar much higher. Kind of like, I'm not saying that's what we're seeing today, but majority of the currencies in the world, the Japanese yen, the euro, the Canadian dollar, they have all collapsed versus the dollar recently. Ultimately, we reach a point in 1933 that the dollar was so overvalued that they tried to get into a meeting in London to see if they could agree on something to promote growth again. And guess what? Roosevelt left the meeting and said, look, we're actually going to have to devalue the dollar. Once that happened, the dollar collapsed, and that was sort of the end of the Great Depression. So I don't think it's necessarily exactly the same way. My point is, we don't know if it's an organic or less coordinated act like the 1930s or the 1985 environment. What we do know is that the dollar is at its peak most likely, and that's the key part of it. So as an investor, you think, all right, well, I have that as a landscape. What do I do in that scenario? I mean, emerging markets could be a good place. Natural resources can be, it's sort of a green light to a lot of asset classes that have been ignored for a long time, in my opinion.
Tavi Costa points out that silver has been showing strong performance, even during gold sell-offs, signaling a potential breakout. Gold miners also thrive, with increased profitability due to high prices and lower production costs. The speaker believes silver could soon hit a significant psychological level of $40, completing a historical cup and handle pattern, which may trigger a significant price rally. Additionally, acquisitions in the silver mining sector and increased M&A activity suggest a growing interest in leveraged opportunities. The focus is shifting to junior exploration stocks, which have historically seen the most movement in a bull market. The speaker has strategically invested in this sector, anticipating a broad market upswing. Now let's shift our attention towards the interview.
I started talking this last few days about silver. People said, well, we've been talking about this for a long time. Those are usually the times you want to pay attention to. Silver has been acting short term in a very positive way. Every time we see a sell-off in gold, silver has been acting better. Some of these sell-offs have been pretty large sell-offs in gold prices that we don't tend to see, and silver has been behaving very well. Gold miners have been behaving incredibly well too. So I believe we're entering that moment where the derivatives of gold are starting to look very, very attractive near term. It wouldn't surprise me if we see a jump in silver prices to finally close at a quarterly high in terms of the candle. A quarterly high would be around 40, and I know it got to 50, but 40 would be a big jump where we are, not in percentage terms, but psychologically speaking. If you look at the cup and handle that we have historically, that would finally close that cup and handle and potentially show that we would see a breakout. This would be huge. And so I think we're very close to that, and it wouldn't shock me at all if it happens in a month. Nobody has the answer, nobody has a crystal ball, but as an investor, I've been accumulating for a very long time. I've been thinking about things that have leverage to silver prices. We recently made an acquisition of the fourth largest silver mine in the world. Very few people know about it. It's a private company, and to me, that's really the opportunity, is to find leverage on silver prices when people are not paying attention to. And keep in mind, why the derivatives of gold? The mining companies are finally making money in a degree that we haven't seen in a long time. And look, the cost structure of most miners is at least half of what the gold price is. So gold price is at 2,900 or so. Their cost is around 1,400. And
Newmont, $5 billion free cash flow this year.
It's insane. I mean, most of the numbers show that you have a pretty steep increase in free cash flow. Now, historically, when you have that, what you tend to see is that exploration stocks are also about to see something, because the M&A starts to occur. We've seen M&A across more mid-tier and seniors, but I do think that's going to come down to the bottom, and it's going to be really interesting. Let me put it that way. I do think there's a lot of explosive opportunities in the exploration market, which tends to be the market that moves the most when you get into a bull market of the derivatives.
So would you be positioning into the small juniors that have potential as opposed to the large caps?
Well, it's a bit self-promotional, but I've been positioning for that, which takes time. Those are very illiquid things, and you have to, prepare yourself in terms of how to deploy capital in those things for a long time. But for the last 2 to 3 years, we've been putting money into this part of this strategy, of which, we hit some major discoveries, probably some of the most successful discoveries we've been involved in the last 3 years. But I think that all boats are likely to be risen here soon. So it's going to be not just the successful stories, but we're likely to see other things moving higher too.
The growing divergence between gold reserves and national debt, increasing central bank demand, and potential currency devaluation suggest a bullish outlook for gold and silver. Investors are eyeing opportunities in mining stocks and exploration markets as interest in precious metals rises, anticipating significant gains shortly. How might a weakening US dollar impact global markets and investment strategies? What factors could accelerate silver's breakout beyond the expected $40 level? Drop your thoughts in the comments below. If you enjoyed this video, give it a thumbs up and subscribe to stay updated with our latest content. Thanks for being part of our community.